morning. Happy Monday. Thanks for joining us.
It's all good, Ben.
Let's begin with I'm getting shaking out some of the cobwebs from the weekend. Let's begin with what's kind of limited in terms of economic data. The GDP number is going to be at focal point, but heavy in terms of central bank activity. Do you expect any surprises from the Fed this week, the ECB, or the Bank of Japan tonight?
Well, the Bank of Japan has already indicated, I think, that they're going to have a bond buying program that is, to infinity and beyond, kind of like ours is. And in terms of what our Fed is going to do, I don't think they're going to do much other than to reinforce the point that they'll do whatever they have to do, which they've already been doing. In terms of the ECB, that one to me is kind of the one that's up in the air as to what they might do. I think they're the ones that are in the most precarious position here and almost dealing from a position of weakness, not a position of strength here. So that one to me is going to be the one that is maybe moving the markets the most of these three.
Yeah, it was interesting last week, and I agree. I think that the Fed's going to be something to keep an eye on, or the ECB potentially as well. But Scott, let's talk a little bit about how last week we saw Treasuries rally. They took out the April highs, the bonds and the 10-year, but we saw limited follow-through to the upside. Is what you were just talking about, are we seeing an indication of that in terms of expectations in the futures, in the Treasuries, but also in terms of rates? I mean, very much range-bound. We have the March highs, the March lows to keep an eye on, but right now, for the most part, we've been contained within that range. I mean, if you take a look at the TYX below 2% and above the March lows, you've got the TNX, the 10-year, below 1.4 and also holding above the March lows. Is this a reflection of expectations from central bank activity this week?
I think it is. This is maybe one of the first times that we've seen probably in the last 6 months where, the expectation is for nothing. Leading up to this, it's been, widely perceived and high odds that we were going to see rate cuts. So this is one of the first times in a while that we're not seeing that. And like you just said, I think that's why we're seeing a very range-bound Treasury market.
Scott, let's talk crude oil. A lot of focus on that, and I know you're dialed in on it. We saw selling this week, or last week again, and started to continue, it seems like, already this week. We're seeing a little bit of weakness. Crude right now down 24% this morning. The indices, though, for the most part, they're shrugging off some of the weak jobs data. They're shrugging off some of the concerns here. I mean, this is a force to be reckoned with.
No doubt about it. And Stephanie had some great commentary about that in terms of historically, what you see with the oil market versus the equity market, or, commodities versus equities. And there's no question about it. I think, 6 months, 12 months, 18 months from now, maybe we'll be able to make some sense out of the divergence that we're seeing here. But what's happening right now is the reason there's so much pressure. It's not just the demand destruction any longer. It's, there really is no place, or we're running out of places to store oil. We are now up to, I think as of this week, it's going to be over 80 or 85% capacity. That number has been rising, weekly, daily. So, where are they going to put the oil? I mean, they can't put it out at sea anymore. They're just literally physically running out of space.
Now, this could change, though, Scott. I mean, we're starting to hear about reopening plans. New York, for example, Governor Cuomo starting to talk a little bit about the process associated with it. Some would argue maybe too soon, too much too fast, potentially, but maybe that's what's helping support prices, and maybe that's what the indices are more focused on right now. We always say, again, how the futures are 6 months forward looking in theory. Maybe they're saying, hey, we're going to be able to shrug this off. We're going to dust off, lift ourselves up, dust ourselves off, and get back into, a sense of normalcy at some point soon.
Well, that's the only thing that makes any sort of rational sense, if you think about it, because all the economic data, everything else we're seeing is so dismal. However, like you said, it's forward-looking about 6 months or so. We know that. And so if we are, able to start reopening, and if a month, 2 months, even 3 months from now, maybe we're back to 50% capacity in terms of, economically and businesses opening, then you're right. The market is reflecting that. I think there's some caution to that. I'd like to think that the market is 100% right. I think we would all like to think that based on, health and safety and welfare of everybody. I'm a little bit cautious about that.